RBI Governor Shaktikanta, they're addressing the nation on the takeaways of Monetary Policy Committee meeting that ended this morning. Interesting takeaways, but most importantly, and the headline here is that the repo rate remains unchanged. There is a pause, Krishna. This is what was expected. Various analysts, people who appeared on our shows have constantly said that inflation remains in the target range, although, very interestingly, RBI Governor saying it is in the target range, but it is not tamed just as yet. And we need to keep Arjuna's eye on inflation. So, of course, inflation remains a cause of concern, but overall, macroeconomic conditions prudent enough to keep repo rate unchanged.
Right, and also quoting the great Mahatma Gandhi as well, saying that that's not good enough, this is not ideal enough. And that's fair enough, at a time when inflation is going through the roof in economies across the world. India is keeping an eagle eye, or Arjuna's eye, on inflation. That's the big message coming in. This also ties in with that OECD and World Bank growth forecast for the current financial year, that is 23-24, where that OECD, or Organization of Economic Cooperation and Development, and World Bank forecast that India will grow at 6.6%. From 5.9%. They upgraded that forecast just yesterday. And today, Shaktikanta Das, our RBI governor, has put that number at 6.5%. So that's an important number to look forward to. The current year's growth forecast, 6.5%, lesser than last year. Last financial year, India's GDP grew at 7.2%. This year, it's set to grow at 6.5% according to the RBI, and according to the OECD and World Bank group report, it's going to grow at 6%. And they're saying that because of the kind of monetary tightening that's already been happening over the course of since the month of May last year. That's what even Shaktikanta Das alluded to, 250 basis points. That's been the rate hike since the month of May last year. Now, for the second Monetary Policy Committee review running, you have that rate hike cycle being stopped or paused. Not stopped, but paused being the right word. And that's the big headline and the big takeaway, Shweta. The fact that there have been 2 consecutive monetary policy reviews in which there has been no rate hikes, although that's been the trend for the last 12 months. And that is what is going to show in the GDP growth for the current year. Because as Shaktikanta Das, the RBI governor, rightly pointed out, the rate hikes by the RBI will start reflecting in the rates of the banks over the course of the 1 year. So people will be feeling the impact of all the rate hikes of the last 1 year during the course of this year, and that's why you're going to see the GDP growth come in less than the 7.2% last year, essentially speaking.
All right. So the impact of all the tightening that's been done by RBI, by the way of MPC, will be seen in the months to come ahead. But let me quickly run through some of the key takeaways from that big press conference, and much awaited there. Headline inflation, RBI governor says, is still above the target and expected to remain so. MPC, of course, decided to keep repo rate unchanged at 6.5%. The focus remains on withdrawal of accommodation. Uncertainty remains worldwide. Inflation is above target, not just here in India, but of course everywhere else as well. But demand is robust in the country. Urban demand is resilient. Rural demand is getting better. So rural economy there is getting better and on a revival path by the way of numbers. The numbers that we're talking about is sales of FMCG goods to automobile. All that, of course, quoted there by RBI governor. Those are the big takeaways of that the press conference that just concluded. Joining me at this point in time is Subhomoy Bhattacharjee, who is a senior journalist. Also with us is Karan Mehrishi, who is an economist. Subhomoy, I want to come to you first. What, according to you, stood out in that press conference?
Well, definitely his accent on inflation. I would not put much stress on the 10 basis point reduction. That simply just more of an optics. It basically shows that the RBI is fairly uncomfortable with the current rate of inflation. He kept on saying that, and that as you were also discussing, that's absolutely correct. Inflation doesn't give any room for comfort. Also, you would notice that he's talking about the fact, which has also been pointed out by analysts, that there's a lot of surplus liquidity in the system. That sort of a situation always, and if there's monsoon play becomes erratic, always gives a spur to inflation. Also, there's an election every year. So all of these combined makes inflation a very good possibility of flaring. So RBI is definitely looking at inflation as its basic challenge. Withdrawal of accommodation on that committee voted 5:1. Yeah. So basically, all of these things together, RBI is sort of, just sort of making it, allowing things to move in driblets, which is important. But along with inflation, the major thing that RBI has also said, which markets would be looking at, the bond markets, is that obviously RBI is saying that the government's bond program will go through without any hitch. Now that's an important thing because the bond markets tend to react to any inflationary circumstances. So both the fact that RBI is being strong on inflation and the announcement that RBI thinks that the government's bond program is going to be comfortable. And third, that it is actually looking at surplus liquidity as an area of something that he didn't say it's an area of concern, he just simply mentioned it. But that mention is significant because it shows that there's money flush in the economy. All of these tend to move bond yields, which makes it difficult for the government to borrow at the current rates. So RBI is definitely also ensuring that the inflation control will ensure that the government doesn't run into, and also, this also includes lots of state governments, that their borrowing program doesn't run into difficulties. So that's the combination that the RBI is trying to ensure through the rest of this fiscal. Growth definitely takes second stage at this point. It's the first thing is to ensure that inflation doesn't really go out of the kilter. Yeah.
Okay. Interesting. Inflation stood out for Subhomoy, and what Governor essentially said is that inflation, although it is going to ease from 5.2% to 5.1%, or 10 basis point reduction there, as Subhomoy mentioned, but still above the 5% target, and being tolerant is not enough. An Arjuna's eye or an eagle's eye is essential on inflation. Inflation remains a cause of concern, Karan, at this point in time. And although it is tolerant, we are tolerant, and that is the limit that we've drawn for ourselves, it's not good enough. And RBI Governor emphasizing on the fact that we need to be more careful and have to wait and check how the current tightening or the past tightening of the monetary policy is going to result in and control inflation, if at all, in the coming months ahead.
So thanks, Shweta, for having me on the show. On inflation, I'm expecting headline CPI to average around 5.3% this fiscal, compared to nearly 6.7% that we saw last year. Core CPI is my concern. It will remain sticky, and I expect it to come in at around 5.8% this fiscal, which is about 50 bips lower than what we had last financial year. This is largely driven by lower wholesale inflation, which is inflation at the producer or pre-retail level, which is expected to fall to around 5.2% this fiscal. This, if you compare this number with last year, then it was almost 10%, about 9.5, 9.6%. For now, factors in favor of lower inflation, Shweta, I think seem to be a somewhat expectation of a normal monsoon and lower volatility in the commodity prices. Nevertheless, these figures, I think, will see an upward revision in case monsoon is deficient, as that would have a direct bearing on not only food prices, but also rural consumption, in my opinion. My sense is that the headline number is still uncomfortably close to the upper band of the RBI's inflation target range of 6%, as Subhomoy was also pointing out. So the situation has remained so until Q1 this financial year, but will converge to the lower band of around 4% by the next quarter, that is Q2 of this financial year. Core CPI would, however, remain near the 5% levels for now. But just to point out about what my sense is about the economy from the RBI's perspective, if I look at the RBI's balance sheet, Shweta, then the economy has almost normalized to pre-COVID levels. So the size of the balance sheet is now 2% of the nominal GDP, which was same as was seen in FY19. That was a pre-COVID year. Deposits, which show on the liability side of the RBI's balance sheet, are now back to 21% by the end of FY23. Again, almost same to what we saw in FY19. What this means is that liquidity in the system has now gone down substantially, and this should check inflationary tendencies in the economy. Since the RBI had to resort to selling some of its foreign reserve assets to stabilize the rupee, I see that currency in circulation has also increased by just 7.8% in FY23 as compared to a 5-year average of over 15% seen previously, especially due to the COVID-related monetary easing that the RBI had to commit. I believe this is another sign of a normalizing economy and curbs inflation tendencies and anchoring household expectations. Nevertheless, I think stabilizing macros and market expectations have led to yields stabilizing as well. And therefore, the RBI's revaluation account has expanded by a significant 21%. This, if you compare again historically with a 5-year average, that comes to around 8%. Apart from that, I think there's a predicament. If you look at what the MPC, the consensus among MPC members goes, I think what is happening is that some internal members think that rates must remain higher for longer to effectively control inflation. And I think this is because they are not very sure whether things have normalized completely. Therefore, in my opinion, the first rate cut will not come before Q3 this financial year.
And that is going to be an interesting quarter for a rate cut. And in fact, we were discussing this, Krishna. This is a crucial year overall for the government as well. And more so because everybody, and the government especially, would be expecting some sort of money for people to be spending. Karan, they're saying that there will not be a rate cut before third quarter of this year. That would be the time around when the country goes to polls, means more money in people's hand, augurs well for the government. But of course, it's a hard target to meet.
Right, but it's also the reason why they say the GDP growth for 2024-25 is going to be 7%. And that's because of the monetary policy easing that is expected in the second half of 2023-24, financial year 2023-24. So,
right.
Even the OECD and World Bank Group report estimates that the rate cuts will start happening in the second half of financial year 24, and that will lead to better GDP in 2024-25 of 7%, as compared to around 6% this year.
Okay, no, so the projections, if I'm not wrong, and maybe Subhomoy can also come in at this point in time, what the GDP projections for financial year 24 from RBI is at 6.5%, Subhomoy?
That's right.
And that is quite in line with what other major reports around the world are also suggesting.
Subhomoy, if I just wanted to ask you, if I were to ask you, the OECD and World Bank Group report pegged India's growth, GDP growth for the current financial year at 6%. It upgraded it from 5.9% to 6%, whereas the RBI has now come in. The governor has put that number at 6.5%. Interesting, isn't it?
It's interesting, but also, as you see, the inflationary conditions don't leave much room for comfort. So RBI cannot push on the growth pedal. If you've got to steep on withdrawal of accommodation, which means that you're essentially saying that surplus liquidity in the system is a cause of concern, and as you're just also pointing out, 2,000 rupee notes, Karan was also pointing out about the data on the liquidity. Essentially what you would essentially get is that RBI will be all hands on board looking at inflation. If you are going to ensure that the slightest fluctuation or position which would give inflation a fillip will need to be sort of cleaned up, mopped up, then you jolly well cannot take measures which will be pushing growth. That obviously means that you will just leave growth to essentially move on the basis of the forces that are already happening in the economy. That would mean the growth push largely will stay from the fiscal position. It will stay from the fact that India has, sort of sorted out many of its problems in terms of policies which allow investors to come in. And that is about the best that the RBI would want to offer at this stage, which I think is a very prudent position to take. Because remember, there are lots of as moving parts in the world economy. For instance, does the oil economy become worse? Does the do the exports, which are just sort of, holding on, do they become difficult? Imports, for instance, one of the reasons why our current account deficit is is tolerable now is because we have had a shrinkage of imports. Do those imports turn back again into a more expanding, larger volume of imports? And also the fact that if even at the current stage, even at 6.5%, we are saying, the governor himself said, FDI flows are expected to rise. Already non-resident inflow into the economy in April has net become $8 billion. The more of those flows come in, the more RBI automatically has to push in rupee into the economy. Once it does all of that, inflation management again becomes a difficulty, because obviously if RBI has to put in currency into the economy, it'll have to ensure that others don't keep on playing around with that currency to push up prices. So therefore, saying that, we look everything together just to ensure that inflation doesn't get out of whack. Borrowing, which is for this year by the central government, is actually much higher than last year, stays on track. The bond yields don't rise up. How will you actually be looking at growth? You just expect that the growth is, it's almost, I won't say the word autopilot, but reasonably, that since it's reasonably good, let's stay there. That's about it. Yes.
Right. At this stage, the only question is that simple answer I'd like to ask is, is the 6.5% growth forecast for the current financial year by the RBI a little too optimistic, or do you think it's in the right direction?
Let's take that question to Karan as well. Yes, Subhomoy.
No, that's fine. 6.5 is more or less, it works. It's, if the monsoon stays okay, agriculture is looking at around 4%. If manufacturing sort of continues with the current rate and services being buoyant, 6.5 is something that we will possibly land up. Yeah. Okay.
Karan?
So my expectation is 6.5% anyway for FY24. And I think it will increase to around 6.8% next financial year. So the primary growth driver, which was the fixed capital formation segment of the GDP, is expected to continue to expand by over 10% this fiscal. And as you understand, the public capex is driving that segment. A very similar story is coming from the private consumption or household consumption segment, which is also expected to expand by over 10% this fiscal. So I'm expecting the industry to recover as well with about 5.7% expansion. This is almost double to what we saw in FY23. For Q1 this financial year, even though the RBI is estimating the number to be around 7.5, 7.8%, but I expect it to expand by in the range of 6 to 7%.
Okay. A couple of interesting takeaways from that big press conference, of course. One was with respect to e-rupee, and I'm shifting focus a little bit. And there is a proposal, of course, by RBI to expand the scope and reach of e-rupee vouchers to PPIs. E-rupee, and we were discussing this, me and Krishna, just while the conference was on, and Shubhomoy, maybe you can come in. The uptake of e-rupee, or rather acceptance of e-rupee, has not come in line with what the government was projecting.
Yes, but then it also depends on what I would call, we are a low per capita income. And in that sort of an economy, consumers, it's already a very major change that has happened with consumers coming into UPI. It's a huge expansion that's happened in the space of last 5 years. Once that is stabilized and played out through the system, the next range of innovations in the market in terms of e-rupee and others would tend to then take over. So we are, I would say that the way if you look at the first initial movements on UPI, where, volumes rose very gradually, and then it sort of shot up like massively over the last 3 years, I think would similarly be starting to happen in other innovations. Not every innovation becomes very successful. For instance, the RuPay cards, which the RBI governor was talking about, is something that will require a lot of the ecosystem to come through. These allowed prepaid forex cards on RuPay. These are some things that will, considering that the rupee is not something which the the higher middle class picks up, that will take time. I mean, and they are the ones who move abroad. So since if they are not using it, you won't expect too much of demand for rupee to immediately start.
Okay.
So these are the sort of things that takes time. I mean, as I expect that over the next 3 years, the per capita income would be really rising up, simply because of the fact that the growth that you're getting in the economy, you would expect the next round of innovations to also start catching. Yeah.
All right, and innovation, of course, we are very good at that, Krishna. We keep talking about UPI success story, and it is a success story. You know, literally 1/3 of transactions done within the country are now done through UPI. So while there's not much of an uptake just as yet, but it is an innovative, medium mode, and will take time for people to start accepting e-rupee like they did with UPI.
Yeah, while we wait on that, I thought there was another interesting announcement talking about innovation. The other good innovation that's done really well is RuPay and the RuPay cards. And you saw that announcement by the RBI Governor that now you're going to have prepaid RuPay Forex cards that are going to be made available to help Indians travel easier. And that's another fantastic announcement. So the good thing is that there are a bunch of innovations that the Reserve Bank of India has been out with. A couple of them have been outstanding. One, UPI, one of the greatest innovations possible from India's from the Indian government's end. And then you have the RuPay as well. As far as the e-rupee is concerned, well, I'd say as far as the offtake of that is concerned, I don't want to be the crystal ball gazer over here, because it's very difficult to see how soon or how late will there be, more people taking to it. But meanwhile, RuPay is doing really well and it's going global.
Okay, RuPay, they're doing well. Karan, do you agree with that? I also want to briefly, from an urban set of people using Forex cards to RuPay to e-rupee, I also want to move into the direction of how rural economy is doing very, very soon. But I want to first understand from you, do you agree with what Krishna had to say? I mean, of course, you can't predict with these matters, but India, of course, a fast adoption of technology and fast adoption of anything that makes lives easy.
Well, it's an inevitability, Shweta. So I think the more the economy evolves and organized, you see these kind of innovations taking shape. Also, as India integrates more with the global economy, and especially India's Look East policy, for example, where India integrates with ASEAN and other Asian nations, you will see even more such innovations taking shape.
Okay.
Domestically, I think the primary driver for this technology, I think, would be the involvement of much larger token transactions, because I think at this point in time the token amount is very little. So I think in order to have a more sustainable development in this space, the policymakers should focus on much larger token transactions in the medium to long term.